Hey everyone, hope you're having a good day. My name's Andy. My channel is Finding Value. Today we're going to go and do our daily technical analysis update of commodities. I'll give you my financial opinion and we'll walk through the dollar yields, precious metals, and commodities. I go through this daily so you guys can see what I look at. It's mainly a combination of reading candlesticks, the size of the candlesticks, and the relationship of the candlesticks to each other to kind of determine short-term price movements using buying pressure, selling pressure, and reversal candlesticks. These things are statistical probabilities. They're not 100% outcomes. It's also what I've found some of the least reliable. I think as you zoom out a little bit and you get bigger picture view, you get more reliable movements as long as it's a long enough time frame. The long time frame, it's the fundamentals that are driving these charts in the directions that they're going. In the short term, anything can drive it for any length of period. So as we look at this in the short term, anything can really happen. If you've got news that comes out, if something were to, whatever it is, an event happen, an earthquake, a war, whatever it is, it can impact things on the short term. And the long term is the structural markets underneath that are driving it, the supply demand fundamentals. So when you look at something can be bearish in the short term, even though I'm ultra bullish in the long term. You can be both bullish, bearish, given different time frames. So I just want to kind of go over that. We'll walk through it together here and look at the short term. Again, it's just my financial opinion, and we'll go through it together. So this is the DXY. Again, it's a relative strength indicator. It's not absolute. So when someone says the DXY is going up, it's up 10%. Well, it's up 10% against other falling currencies. So the DXY is still falling. It's just falling less than everything else. And this relationship between the dollar and other currencies is important because if you're pricing assets in dollars, then the dollar has an impact on the asset. So if you were to look at gold and you priced it in other currencies, gold will be going up differently given the denominator or the currency that you're pricing it in. So when you look at all these different assets and you price them in different currencies, you're going to get different looking charts and whatnot. I'm looking at the dollar because that's what we price things in. And as this dollar strengthens or weakens, may determine the outlook of foreign investors and where they should put their money. So when the dollar goes down, the DXY, that is, the relative strength of the dollar goes down, we usually see gold go up, precious metals, and we see anything that's denominated in dollars go up. Even stocks, I think, will do better than what they're doing as the DXY goes down. These things are complicated. They're not super straightforward. There's many, many things that make assets go up and down. It can be supply, demand, fundamentals, the currencies that they're priced in, jurisdictional risk and tax risk, and all of these. I mean, there's thousands of things. And you could have very strong opposing forces that are at work. So you could have the supply demand fundamentals of a sector be very strong. And they're very strong for uranium, copper, and all these other sectors. But the dollar could be an opposing force to the move. And same with the overall stock market as some of these things sell off and they're linked together through the leverage in the system. So when you look at the dollar here, we are going on up. It's a stronger dollar. People are preferring dollars over other currencies. And there's a lot of weakness in other currencies for a variety of reasons. It could be an energy crisis. It could be a recession somewhere else. It could be a combination of a recession and an energy crisis all happening simultaneously. Their bond market is about to collapse. The currency is about to collapse, et cetera, et cetera, et cetera. And if you've got currencies that are about to collapse or bond markets that are collapsing, that could be additional demand for dollars and or assets that are based in dollars, like our bonds, our treasury bonds. And what I think you're seeing is you're seeing exactly what I'm kind of describing here. We're seeing a stronger dollar relatively. We're seeing stronger 10-year yield, and these 10-year yields continue to go up. And I think that is being exacerbated around the world with people being scared of bonds. When people get scared of bonds, they sell bonds. And we're seeing an increase in the 10-year yield, and maybe there's other factors that they have to raise cash to pay dollar-denominated debts, whatever it is, whatever the reasons are. And it's moving on up. And we've got TLT, bond prices are continuing to go lower. This is definitely in a downtrend. There's no denying that. But I mean, even if someone's down 10% in their investment portfolio this year, you're doing better than bonds. I mean, this is a pretty big move on a bond, which is down 20% or so, somewhere on the lines of that or more. We've got TYX. That one's also rocketing higher. People are selling bonds, the 30-year bonds, and yields are going on up. And again, this is a long-term major breakout of yields. And the overall stock market does not like this type of movement with the dollar going up and the yields rocketing on higher, because stocks are they're just a derivative of the yield. As the yield goes up, people are less willing to speculate and take on the risk in stocks. So they sell their stocks and they may buy bonds that are yielding 3.8%. And that's where we're at today. And when we look at this ratio, really what this is telling us is how the curve is inverting or uninverting. That's what this ratio is telling us. And that's kind of the way that I'm thinking about it. And what's really driving this, it's not that I'm using this. This is a function of the market condition. This is what we're looking at. It's a function of the market condition. This market condition here is panic and selling and people running into bonds. They printed a bunch of money. This is panic and everyone's selling those. It's the unwinding of that trade. And we're down here. We're very low in this. And that's historically a good time, historically, statistically speaking, to be looking at precious metals as you can accumulate these bottoms. Now, does that mean that we're at the exact bottom? It does not. Why do I think we're not at the exact bottom? Because we have a lot of imbalances in the market where I think oil could rip it. And I think oil is the driver of this unwinding. So when you look at market collapses where things start to get all nasty as this goes up, we'll call it the 10-year yield is dropping at a faster rate than the 30-year yield. That's usually this type of environment. That is when people seek safety. They're afraid of the markets. They run towards precious metals. They are looking for a reflation trade, so to speak, from the markets at some point. We got our capitulation bottom and reflation at the bottom there, and that's this thing tightening up. And the inflation is, in my opinion, is being driven by oil, is the main driver. And when you see oil go up, usually TYX, TNX pulls on back. We saw that pull on back today, down 0.25%. That is a headwind given stronger dollar and all these other things for precious metals. So when we look at commodities, commodities are heavily weighted in oil. Oil had a terrific day today, and we've got the CRB index heading higher. Very strong. The CRB index is ripping higher in the face of a market sell-off, in the face of DXY, in the face of the 10-year and 30-year yield going up. That is part of the money rotating, because commodities, in my opinion, are kind of the safety of it. It's a safer type of investment, or we're in the market conditions where the market conditions kind of investors choose or focus more on commodities and those types of investments given the market condition. And this stuff these things can change very rapidly. And the markets are very, in the short term, can change very, very rapid. They can change on a dime. So gold, stronger dollar. We had nice, good buying pressure here. We had a small little sell-off, but today we got whacked a little bit more than what even I would think when looking at the charts. And we got some sellers that came out and started whacking this thing lower. Now, we've broken this downtrend. We could do a return move here, but this has been quite strong given how strong the yield curve's inverted. But looking forward, I still think the imbalances in oil are dramatic, and we could see a very big move in oil this winter. So does that make me super bearish on gold? Not really, especially not the physical stuff, because I think the physical stuff's going to literally run out. I think they're in there. People are getting scared, and I think we're buying lots of physical around the world. Silver, same thing. We're getting to that pullback. Again, the market conditions, the inverted yield curve, and the strength in oil. Think inflation. Platinum kind of trades on its own accord. Sometimes it likes to be trading with gold and silver. Sometimes it doesn't. It's very different. And sometimes it wants to be palladium and rhodium and who knows what. But this still looks good to me. This still looks like we could go higher. I don't think the sellers are necessarily in control of this. They're looking like they're in more control of the gold and silver sector in the short term here. XAU to gold ratio, it is falling on back. Stronger dollar, stronger yields. Oil's heading higher, which is inflationary. It's going to put inflation through. So when you look at all this, what we want to gain from it is an understanding that gold and silver, the monetary metals, do very well under market conditions where the curve starts to uninvert, when inflation starts to ease, when people perceive that the real yield is getting more negative, that the curve is uninverting. That is what I want you to burn in your head. And as we look at these, we're seeing, sell-off, SILJ. It's still within, it's still grinding sideways. GDX is grinding sideways. And that the market conditions in the short term have changed. What has changed here? What has changed where gold is starting to move a little bit different? OPEC. OPEC 2 million barrels, right? Now, what we're seeing is OPEC override the central bank and their ability to control the markets. They are the central bank because when the world is short on oil, oil is going to drive inflation. And anywhere where we've seen an energy crisis in this stuff, guys, that energy crisis over in Germany and UK, look what it's done to their bonds. Look what it's done to their currencies. Look what it's done to their consumer price inflation numbers. Wherever there's an energy crisis, there is inflation. And they're running to gold. So we've got opposing forces in precious metals at this time. The opposing forces are, we've got large forces coming in with the inflationary front and the yields that typically push gold around. But what's going to happen is if we get fear in the market is going to it's going to force people to run into safety. They can't use currencies, they can't use bonds as a form of a safe investment anymore. They're going to figure this out and they're going to run to gold. So we've got these opposing forces developing in the market that are going head to head right now. And I think with time, the scared and the fear is going to drain the physical markets. And it's going to override what has historically been a trade based off of yields, safety, and stuff like, in terms of yields and dollar weakness or strength, kind of the old paradigm. So this is going to be incredibly volatile. And I think things will start to change based off supply-demand fundamentals. But this is all driven by financial movements in the markets. Crude oil. Now, remember what I said yesterday. I said we're seeing the opening and closing prices on all these start to contract. That is a true statement. We're playing with statistical probabilities. And the move here is to see it if we're going to go lower. But what happened? What happened is we shot on up. In the short term, anything can happen. And we've got that nice big move to the upside there. This is ultra bullish for crude oil, guys. This looks really good. Now, if you're looking at this, you should have been looking at crude oil in this general vicinity here, like we were on the website, the finding-value.com platinum membership. We were looking at that stuff saying, look, there's some good opportunities down here. Let's start looking at them. And we break out. A lot of the times we get a pullback. This time, we may not get that pullback. So we're heading higher here. It looks good. Finished strong. Crude oil looks absolutely good in a ballistic way. Natural gas is still chugging around here. We've got an head and shoulders pattern. We've broken to the downside. We've got a little bit of sideways action. We're kind of trading in this little thing here. We could pop out to the downside one last time and head higher in the fall here. We know the Freeport LNG terminal is coming back online late November. So there's a little bit of time between now and late November. We could see a pullback here that gets us a little bit lower, maybe even as low as this, maybe even 550, 560. If that's the case, I view that as a buying opportunity in natural gas companies. I will be a buyer in this general vicinity there. Why do I like natural gas? I know some people were asking me about the ratios, technical analysis, market conditions. How does it all tie together? This is where experience helps you, or just kind of logical thinking things through, because it gets more difficult as the ratios become. They're not as cut and dry as everything is cheap all at once, and you kind of buy everything. The reason I think this is going to do well, crude oil and natural gas, is because they have the Freeport terminals coming back online. We've got really high gas prices over in Europe, and then crude oil was being held down by the Strategic Petroleum Reserve. OPEC did not like that. OPEC is doing the right thing here because they need to get oil prices to a level that can spur demand, or supply, that spurs supply. We've been eating through inventories. They irresponsibly are releasing strategic petroleum reserves and making the situation worse. They're doing it to get elected. They are doing it and ruining, and what they're setting up is a gigantic oil spike here. A gigantic oil spike. Because we could be losing barrels later, the spare capacity. Once your spare capacity is gone, then you're subject to whatever problem in the market you can get, and there's just nothing that can absorb it. So this price, I think, will go to something far greater, $30, $40, $50 more at least. And then if we see a problem in the market, you could see another $100 added on top of that. $100 added on top of where we are today. So it depends what the market, what happens. It depends on supply demand fundamentals this winter. Depends on oil to natural gas to oil switching. There's a lot of stuff going on here, and the markets are the tightest they've ever been. They need to get the price up and get more supply online immediately, is what they need to do. XOP, yeah, you know me, rolling sideways. We're getting a little bit of selling pressure here. Remember, I talked about the resistance up here. We're getting that hit of that resistance. We've had multiple times we've had resistance up there. We could see a little bit of a pullback if oil pulls back. But again, oil's been on fire. It's been on fire. Short term here, we've got opposing forces. We've got selling pressure from the technical pattern of XOP. We've got crude oil going higher. We've got natural gas going lower. We basically have opposing forces all in this mix for these companies. What's going to win out? You can just take a guess, flip a coin. Because we're at resistance here, and crude oil is going higher and natural gas is going lower in the short term. So we're going to see a big mix in a lot of these companies. Energy service companies are also at a spot that is getting some resistance. But again, it's not a huge selling pressure day. We'll have to see what happens next, and we'll have to see what natural gas and oil does. Looking at uranium, we've got the futures pricing that's been moving sideways here. I still think this looks absolutely okay. I don't see a ton of selling pressure. We basically had selling pressure here, less selling pressure. We've tried moving higher. We have a little bit of sellers left, and we're just moving sideways. And the overall markets are not helping us in uranium. They're getting smoked over there in the overall markets. Yields are not helping us. The dollar's not helping us. Right now, nothing is helping uranium to move higher from a financialization aspect. So when I look at Sprott Physical Uranium Trust, if that is the case, we've got a bloody nose on a weekly candlestick. That's good for us to move higher. On the dailies, we don't have any reversal candlesticks here. We've got some selling pressure, but buyers came in and bought it back up. It's actually being very resilient in the face of the market conditions, where it's usually quite weak. So it's got its DNA in commodities, but it still has all of its DNA with the overall markets and interest rates and dollar and all that. So it still looks all right. We just need the buyers to step in here and the overall markets to firm up. I think that's what needs to happen. Uranium is also selling off with the overall markets. Again, we're outperforming the overall markets. We're going down less when they're going down. And I still think that we've got maybe some more grinding to do to the sideways type movement. And maybe we even come back to this level here if the overall markets continue to sell off before a move on higher. But that's what I see in the short term. Kind of difficult with everything pushing and all these opposing forces in the markets. Down a little bit in CCJ, more or less a sideways day, but still looking good. We're still within the pattern. Everything is still playing out. We have higher lows and we have a lower high here. We need to break that and get through that to get moving higher. And we don't want to break below, I'd say, this guy here at about $22 or so, and we definitely don't want to break below 20. So that's we're squeezing up here. We're squeezing up where the lows and the highs are converging against each other. And we may go sideways for a little bit. Buyers versus sellers. Looking at TAN, TAN is selling off with the overall markets. We're almost doing the full, complete retest here. And we'll have to see what the overall markets do. This follows the overall markets much more so than a lot of the other commodities do. COPX also selling off here. I do think that we're between a resistance and a support level, and we might do some bouncing sideways. We have to see what the overall market's doing in yields and whatnot. Yields look pretty strong going to the upside. Dollar looks strong, and I think copper doesn't like that. I think it trades more so with the overall markets. Again, that's my opinion. You can debate that. That's a debatable thing that I'm saying there. But we got the CRB to S&P 500. This is rocketing higher. That's that commodity outperformance against the S&P 500. So that's doing quite well. Still looks very strong from a long-term perspective. Nice, strong finish on the candlestick for this month. And again, we're in this month, so it's still progressing. And we'll see how we finish the month out. We've got rare earth metals. Again, this trades more in line with the overall markets, but we're right on support. We've got lithium that's pulling back a little bit today with the overall markets. We look at the overall markets, they're getting slaughtered here. Nice, big, strong down days. We do have a little wick at the bottom. We'll see what happens here. We don't want to lose this here. It's kind of at this last support level. If we lose this to the downside, we could see a rapid sell-off in the S&P 500 and the NASDAQ if we lose this support region. That could also impact commodities and pull it down and yank us down with it. Looking at NASDAQ, we're also at that support level. We could lose this if it wants to move on lower. I don't see a reversal candlestick necessarily here, but you don't necessarily need one. You don't have to have one. So long or big selling pressure today, big candlestick, finish strong to the downside. Let's watch to see what happens next week. EEM does not like that stronger dollar. It's pulling back to support. For EEM, that's a long-term support level, right where we're at. This does look like to me that we want to go lower, though, on a monthly candlestick basis. The buyers are definitely not coming in here. I don't see any strength in it in the short term. And that can obviously change. We'll have to watch it. XHB also moving lower with the overall markets. It doesn't look as bad. We've got the broken down trend. Step one's the breakout. Step two's a higher low. And then we got to break this guy for a new uptrend. $67 for a new uptrend. We've got lumber still in this falling wedge going back and forth. But I'm going to say this. This is at an elevated level. We're at a very high level in relationship to history. So we've got gobloads of support underneath us, a bunch of support underneath us. So we'll see what happens there. Nickel moving, shooting higher today. That's looking stronger. We've got cocoa futures looking better. Again, a little bit of buying pressure today. We've got wheat just moving sideways. Still looks like we could go lower in it though. Soybeans moving sideways. Again, we got to see more buying pressure in a reversal candlestick to reverse this short-term downtrend movement there. We've got corn moving sideways, still in that sideways channel. And then we've got copper selling off today. Fear is creeping back into this market. We had the bearish engulfing yesterday, and there's your fear where I said we could head lower. I don't know how low this is going to go. We have to see what the selling pressure does. We have to see what the overall markets do. We have to see how much fear sticks around in these markets. Mu is also coming on back with the overall market. Still looks all right. Doesn't look horrible there. Aluminum getting sold off today a little bit, but we're right at that support level. We'll see if it holds. And then Baltic Dry Index moving sideways. This has been actually quite strong. So the Baltic Dry Index looks good, in my opinion. So that's what we've got for today, guys. Again, this is a reminder. We've got the Platinum question and answer session at 5 p.m. Sunday, Mountain Standard Time, just as a reminder. So anyone who's a Platinum member, what is a Platinum member? It's the website over here. Sign up to be a Platinum member. You can ask me questions directly. During that, I tape it, and then I post it on the website, and you guys can see all the previous Zoom calls. I've also got a bunch of financial information on ratios, market conditions, and all these things. And that is all on the website if you want to join up. Also, overall markets. The overall stock markets look pretty weak. S&P 500, NASDAQ. It can pull us lower, guys. It can pull us lower. That weakness is being derived from the oil markets, in my opinion. Oil markets going higher is inflationary. It's going to basically start back up the CPI numbers. It's going to put inflationary pressures in the market for the consumer price index to go on up. They are manipulating, or they were trying to manipulate the short term. The Federal Reserve and governments were releasing from the Strategic Petroleum Reserve. They're trying to manipulate the short term markets to get the inflation down and to get gas prices down for better sentiment in the polls. Now OPEC is basically taking the reins and saying, I don't think so, guys. We're gonna cut back oil production. We need oil higher, and we need to bring on supply. And I think that they're right. I think that by holding this down, they're making the situation worse, and we could create a gigantic oil spike sometime in late 2022, early 2023. Because if we get to pumping capacity and we don't have any spare capacity left, our inventories are at the lowest level we've ever been at across the board of strategic petroleum reserves and other commercial inventories around the world. The buffer in the system is really low. It's at a very thin area. When people figure this out, you're going to see oil go much higher. And if we have any sort of problem in the markets, oil is going to spike. That's my take. Spiking oil means spiking inflation. So that's also out there. I think the deflationists are wrong, if there is any. I think we're going to see more inflation because the market balances in oil are all messed up. I think the opportunities in energy still. Energy and precious metals. Energy is what breaks currencies and bond markets. We've seen that across in England. We've seen it in Germany. We've seen CPI numbers go absolutely ballistic. It's going to strain the system. And it's because we are short energy. And this is just the 1970s playing all over again, with 1940s sprinkled in there. They're all sprinkled in there. 70s and 40s and all these different things. So that's what I've got for today. If you guys like the analysis, give me a thumbs up. Subscribe to the channel. Subscribe to the website if you'd like. And I hope you guys are having a nice day. This is Finding Value.